Way out west, could you clarify what I mean by the potential limitations when the 1-year term is burned off? The potential limitations when the 1-year term is burned off. That only happens in it happens in whole life. Okay, it doesn't happen in IULs, but in whole life, when that term insurance goes away, so does your ability to contribute what I call the 10x paid up additions. So if we have a design that's a 90-10 design or an 80-20 design or whatever the split is, that 80 or that 90, that's our paid up additions. Okay? When you run out of term insurance, your ability to put in that 80 or 90 goes away. So you're going to be limited to that 10 or the 20 or a little bit higher than that. So those are the limitations when that 1-year term runs out. So you always want to try to make sure that that lasts as long as you're wanting to make those very large payments. And that's going to be a personal choice. I've got some people who like to just max fund this thing over 7 years, and that's it. Like at that point, we're going to be aggressive in funding it to the MEC limit, knowing that in year 8, it's going to drop down and I only have to fund that very small amount. Okay? So that's one thing. I have a lot of people who like that type of design. I have other people who want to pay for it as long as possible. And so we just tweak it. We just tweak that blend. We tweak how long that term insurance is going to last. We might have to adjust how much insurance we're paying for. It depends on the carrier. But yeah, there's things that we can do to make it last longer or shorter, depending on what your needs are. Way Out West says, could you please discuss the pros and cons of blended paid up additions versus fixed term riders, 10, 15, 20 years, etc.? Oh, good question. It's not so much pros and cons as what does the insurance company require? That's the way I look at it. As far as the pros and cons, I would say typically how we do a blend with paid up additions, we're blending in some annual renewable term insurance. With some carriers, that annual renewable term insurance is going to go away every time we make a payment. Every time we make a paid up additions payment, it's going to replace some of that. And when that's fully replaced, we can no longer put in extra massive amounts of paid up addition. Other carriers have multiple term riders that allow us to blend in that annual renewable term, and we can let that stay on the policy for as long as you want to. There's no particular end date, at least in any sense of the word where you'll care, because you can get 40 or 50 or 60 years with this blend. We can basically design it to go as long as you want. Okay. Some carriers require, because they don't have any other way, they haven't created the ability for an agent to design it to blend in the annual renewable term. So we have to add in the term insurance, the level term insurance, 10, 15, 20 years, in order to get the blend that we want to generate that cash value. So it's mostly carrier specific. I'm not aware of carriers that allow us to just pick one or the other. Might be out there. I just haven't stumbled across it and figured out in my designing, messing around with those. So I think it's carrier specific. Some carriers, you got to blend in that level term. Now the advantage to that level term is that level term is the same cost each year. It's not going to increase in cost each year. Annual renewable term will start out cheaper, but that cost will go up each year. As that cost goes up each year, we're trying to knock it down. We're reducing the amount of death benefit. So the pro on the annual renewable term side is you probably pay less over a shorter period if we cut it off, as opposed to paying for a level term. Because that level term is not going to reduce. That term value is not going to reduce during that term. You're going to pay that same amount the whole time. Whereas with the annual renewable term, we may be paying for less term insurance each year. With the blends that we have that term insurance go for as long as you want to, if you go the full time, that the level term benefit goes for, you're typically better off, you have a lower cost with those level terms. So the cost may be slightly lower. I don't think it's going to make that big of a difference in the long run. I mean, it's going to offset with the annual renewable term, having that lower cost up front rather than a little higher cost. You're going to get more money compounding down the road, I think. So, I mean, it's probably 6 of one, half a dozen out of the other. Probably isn't going to make a big difference. That's my guess. Now, maybe you can crunch some numbers and figure out something different. But my guess is it's probably not going to make much difference.
Hope you found value in today's video. If you'd like to find out more about IUL and whole life, check out these videos right over here, and we'll see you next time.
Now go maximize your cash flow.